Welcome to Realcast, the weekly roundup of the real asset markets. My name's Richard Betts and I'm joined by Nicole Dines, Dan Innes and Paul Strome. Dan, what have you been following?
Adjusting to the pandemic in terms of real assets, Capital and Regional PLC, they posted a new accreditation that they've achieved with World Host. Chief Exec Lawrence Hutchings and his team there, they've become the first UK shopping centre business to train its entire frontline team in a new kind of post-COVID customer service module with World Host. You might remember that they're the same world-class kind of training programme responsible for staff at the London Olympics in 2012. And in a report that they published last week, CapReg's Director of Guest and Customer Experience, Sarah Jennings, said that they recognise the importance of instilling confidence within their communities. And I think that's really the massive priority now. Next up, Shaftesbury. I think you'll remember we've been following Shaftesbury over the last 6 months. They're the central London landlord that owns Chinatown, swathes of Soho, Covent Garden. They've announced emergency plans to raise up to £300 million to help survive the coronavirus crisis. And they've been impacted by a drop in tourists and workers staying away from the West End. And some will be quite kind of surprised by the size of that figure. They've been struggling to collect rent. They collected 44% of rent in the 6 months up to the 30th of September. But they've been really proactive still. They've been offering new lease terms to struggling tenants, rent waivers, shorter leases, and monthly instead of quarterly rent payments. And the chief exec there, Brian Bickle, who I recently watched on a podcast interview with Susan Freeman, he said that the capital that they've been raising, that'll ensure that the group maintains the financial kind of flexibility and resources to navigate these near-term operational challenges. It's interesting that he's really thinking of them in the near term. And then last but not least, in one of the kind of shockwave announcements last week, fashion brand Gap, which is a bit of a household name for all of us, they're considering closing all of its 129 company-owned stores in Europe. So that's 70 here in the UK. And they want to close those by next summer, as well as a major shift that shakes up its portfolio in the US that will see about 80% of its remaining Gap stores being in non-shopping centre locations. I mean, it was an announcement last Thursday by global head Mark Breitbard, and he used an investor meeting to announce this major restructure that will shift the business away from owning stores. The group will carry on with 158 franchise stores in Europe, so we won't see them disappear entirely, but it says the franchise model is where its focus is going to lie.
Nicole, what have you been following?
Landsec, a huge UK company, announced this week that it's selling a third of its portfolio, 60% of which it's in London. They collected less than 1/3 of their rent this year so far from the retail side of their business, where they managed to collect most of the rent from offices. So they're going to focus more on offices and residential and less on retail. That's going to be huge over the next 4 years. They're selling 4 billion of retail parks mainly. But they're also focusing on mixed use. For example, the O2 Centre in Finchley Road in London, which is going to stay as a shopping centre, but they're going to add some residential buildings to it. And again, staying in London, W.R. Barclay, the US insurance group, has announced it's put on sale the Scalpel, which is a shiny new tower in the city, which has sort of raised eyebrows, and is seen as a real test of the market because it implies a yield of 3.5%. Similar to what Cheese Grater or the Walkie Talkie got in Much Happier Times. So if they manage to get that, they're aiming probably for Asian capital. That would be a significant landmark for London. To end on a positive note, the Ontario Pension Fund, the CEO Blake Hutchinson had an interview with the Financial Times in which he announced that they're hunting for property deals in London. They have a strong belief in London offices. He said, we have made more money in London over the past few years than in any city in the world, and that's not going to change. They see the COVID pandemic and Brexit as blips. And so they think the long-term fundamentals are absolutely positive. And he said one thing he regrets is selling the cheese graters. We made a lot of money on it, he said, but I wish we'd held on to it.
Paul, what have you been following in terms of the Real Asset Day?
Well, there have been some interesting partnerships formed or formalised as investors moved out of their usual hunting grounds. A couple of weeks ago, we talked about Korean investor Hyundai Investments formalising its relationship with the investment house La Française to acquire property throughout Europe. This week, we've covered another Korean-European partnership, and that's the Korea's National Pension Service, which has tied up with Dutch pension fund manager APG to invest broadly in large-scale real assets, including infrastructure. And like La Française and Hyundai, they've already worked together, and this year they've jointly taken an 81% stake in Brisa, a company that owns and manages 1,500 kilometres of toll roads in Portugal. The deal valued Brisa at $3 billion, and APG and MPS plan to invest a further 1.2 billion in the company, although that's over a longish timescale, 15 years. They have also jointly taken a stake in Australian student housing operator Scape Australia earlier this year, so that's one to watch. Also on a large scale, we've had the announcement that Kuwait's sovereign wealth fund is partnering Hines, Kale Street and Prelios in a major project in Milan. Then Moorfield Group, on a smaller scale and on a sector focus, has announced it's diversifying into the UK self-storage market, expanding its presence in the alternative segment. UK-focused property fund manager has formed a joint venture with South African self-storage REIT StoreAge, and they plan to build a portfolio of between 50 million and 100 million pounds. Moorfield Group CEO Mark Gilbard said the company's replicating a strategy adopted when it expanded into nursing and dementia care home through partnerships and selecting the best-in-class partner. Hamburg-based property company EC says it's formed a partnership with Google. It's another case of bricks and mortar fighting back, really. The retail-dominated EC said the initiative's part of its push to expand shopping centres into omni-channel platforms. It's using the Stock Square data platform, which is a joint venture by EC and a related company, Otto, which is Germany's second largest online shopping platform. The partnership will enable bricks and mortar retailers to display products available locally in Google search results. Interestingly, EC has also recently established a partnership with an Otto Group platform, Limango, and retailer Jack Wolfskin, where they tried out selling and delivering goods directly from a store via online sales. And the exercise increased the average daily revenue for Jack Wolfskin store in Hamburg by 500%.
And you've been following some of that story in Milan as well, Dan.
That Kale Street investment of 500 million that was announced last week, they've put into that 1.5 million square foot Milano Sesto project. That's the largest urban regeneration project that's on the site of that former Falck Steelworks to the northeast of Milan. And Kale Street, of course, they're backed by the Kuwait Investment Office and do have investments elsewhere, for example, in Derby in the UK. Global asset manager Hines, they've also invested in the same project. They put 250 million euro in as well as other investments into Milan that are nearly pushing 3 billion euro now. So Hines is a big investor there as well. But Milano Sesto, it's a Foster and Partners master plan, and that includes new resi areas, retail, hospitality, and a 45-acre park, which of course is becoming the real badge in these types of huge mega projects. There's a plot on that project called Union Zero, and that's slated to be the first parcel of land off the rank to be developed, and that's 250,000 square meters, and that's due to start as soon as next year. And there's also a new railway station to be completed by 2023. So Kale Street, they're working in a joint venture with the Prelios Group, which is the project and the fund manager for Milanesto SPA. And they're also the owner of the site. So yeah, I mean, there's lots of JVs going on right now, Richard.
Interesting as well, Paul, you mentioned there self-storage. And again, there's been a focus on a lot of these alternative, more niche businesses. And I saw on LinkedIn, Adolfo Ramirez just saying, while many focus in the crisis and the difficulties, we'd rather focus on opportunity and growth, and that the agribusiness will double its size in 18 months and triple in 36 months. So potentially that's something that we may be talking about more in Realcast in the coming weeks and months. Thanks, Nicole, Paul and Dan. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the key themes in real assets. Thank you.